Hi everyone, in this video I will explain why the probabilities from an Elliott Wave point of view on Bitcoin are higher for this range or retracement to not yet be finished. I will explain what to look for, covering several Elliott Wave scenarios, starting with the first one here on my chart, which is the most bullish scenario, a finished three-wave corrective structure, a double zigzag, a WXY, and then we want to see bullish a continuation with an impulse to the upside, a five-wave structure in a wave 1, followed then by a wave 2. Now, the most common target for your wave 2 is the 0.5 to the 0.786 Fibonacci taken from the start to the end of wave 1, giving you a target between 103.3k and 100.3k. Clearly, price so far did not get close to that area. Now, generally, a minimum target for a wave 2 is the 0.382 at 104.5k, which is an important level to keep in mind. Also, because it is at the top of this daily time frame gap as well, which can act as a support. Now, you can also see that I have the 0.236 on my chart at 105.9k. 0.236 is definitely not a common target for a wave 2. In a very strong trend, the 0.236 might act as support, after which we get continuation, but it is definitely more a rare, very uncommon target for a wave 2. One would expect the 382 or the 05786 area to be the main area for a wave 2. Now, besides the price targets, we also have to keep in mind time, and that is where the vertical lines come in. The vertical lines come on the chart using the trend-based Fib time tool, clicking for the first time at the start of wave 1 and click 2 and 3 at the end of wave 1, comparing 1 in time with wave 2 in time. Now, preferably your wave 2 is ending after the 0.382 Fib time and ends before a 4 Fib time, but a 4 Fib time is already stretching it quite far. If we just look at the wave 2s in general, then usually ending a wave 2 between a 382 Fib time and let's say a 2 Fib time is what we see most often, right? A relatively short wave 2 and deep in price, right? That's what is written in the theory books. That's generally what is most common in the market. But what is most common does not need to happen. So therefore, the 382 to a 4 Fib time is something I keep an eye on, but preferably wave 2 ends sooner than later. But the main issue is that wave 2 then did not retrace into the Fibs so far. The low over here was made just after the 382, which is fine, but we didn't even touch the 0.236. So if we are very bullish and we want to see continuation to the upside, then actually preferably we want to take one step back to take 5 steps forward and continue towards the upside. Now, why do I prefer to end wave 1 over here and not over there? Right? I've seen some questions in Discord as well. Now, that is because of this channel, and I highlighted this in the live stream yesterday as well. You will recognize a lot of what I say if you were in the live stream yesterday as well. So this is a base channel, and you can see the internal count of the impulse: 1, 2, 3, 4, and then a wave 5. And the base channel is taken from the start of 1, end of 2, end of wave 1, with then a flat in a wave 2, whatever happens here in 4, and a final push up in a wave 5. Now, this would be the way to count this impulse, because here we broke the lower trend line of the channel, and that is not what you want to see in an impulsive structure, right? Finishing wave 5 here, very difficult because we broke the lower trend line. With a base channel, what you're looking for is wave 3 to escape the base channel and move beyond the upper trend line, which happened. Wave 4 comes back and wave 5 moves up again, okay? And then once an impulse is finished, it is common to break the lower trend line of the channel, which then happened here. So I'm not a fan of counting a 5-wave structure all the way up here, like a 1, 2, 3, 4, 5, because the channel is broken and it just does not make sense, right? So therefore, if we think about the bullish scenario, I prefer this high to be the end of a wave B or a wave X on a lower time frame, when one would count this range over here, but then preferably one still retraces to the downside into the Fibs. But we got to keep an eye on time, because the longer price is moving sideways without moving into the Fibs, the lower the probabilities become for a wave 2, and we have to be aware of other scenarios where the range continues, even if you get a push to the upside and take out the all-time high. Because look at this one, right? This is one that I added on my chart just this morning, just because I wanted to talk about it. So here, your double zigzag WXY down is a wave A of a flat. You're going to be looking for a wave B and an ABC, and then a move, or WXY in B, by the way, double zigzag, and then an impulsive wave is C to the downside, preferably taking out the low of A, most common. But again, in a strong trend, right, you might as well create a higher low, but you still get an impulse, a 5-wave structure to the downside. Now, in this particular case, right, we have the fibs on the chart once again. We are looking for a push to the upside in a B. Now, mind you that the structure inside B is most commonly a zigzag family structure. So a simple zigzag in a wave A, wave B, wave C, or a double zigzag in a W, X, and then a wave Y. And when we think about a wave B or a wave X compared to a wave 2, then if you get an incredibly shallow retracement, like a 236 retracement, it fits better with a wave B or a wave X compared to it being a wave 2, because for a wave 2, we preferably see the 382, the 05, the golden pocket, the 786. Right? So if it is incredibly shallow, gotta be aware of a double zigzag, maybe a wave B and a simple zigzag structure, which of course then also gives some probabilities to this scenario if price would move to the upside. And this is a scenario, mind you, that sure, you can take out the all-time high, but it still continues the range. It is not a breakout. So it's not a finished structure and then a wave 1, 2, and 3 to the upside and onwards we go. Is there a possibility for that? Of course, right? It's trading, it's all probabilities. But from a probability perspective, and from an Elliott Wave perspective, I should say, it makes less sense for that to happen as long as the fibs are not touched for a wave 2 and price to retrace to at least preferably a 382 retracement. So if price would move towards the upside, break the resistance we have here, which I'll show in a second, touch at least a 0.9 at 110.6K taken from the start to the end of wave A, that is a minimum target for a wave B in a flat, or moves above the all-time high without seeing a retracement locally here into the fibs, I'm going to be very aware of the potential of this scenario, which is going to play an important role in my risk management with my trades. Not necessarily expecting enormous continuation and onwards we go, but I'll be very aware of the potential of a drop down back into the range for this wave C. Now, in a flat, it is common for wave B to take out the all-time high, right? So a regular flat is the only flat where the all-time high would not be taken, where you would end between the 0.9 and the all-time high, and then price moves to the downside in a wave C. And you would expect wave C to end somewhere around the low of wave A. In a regular flat, you would take out that low, and we still have some support to the downside. But it is interesting, and this scenario and the probabilities of this scenario will also again depend on the local price action that we get here and the fibs. And preferably, even inside this wave B, if we are looking here for a B or an X in a 3-wave structure, preferably, you would at least touch the 0.236, right? That would be a nice to have. Or, of course, you move into the blue box. And then we get to the longer or two other longer sideways corrective structures. So WXYs, WX flat structure in a wave Y. So also again here, we just continue the range, right? As long as price is not moving into the fibs and it's just probabilities are higher to continue the range. So here we have a WXY, it's a sideways WXY. Wave X here is a flat structure, and then wave Y looking for a flat as well because W is counted as a zigzag. So therefore, wave Y cannot be a zigzag in a sideways WXY. And because price over here took out the high, right, a triangle doesn't actually work. A, B, C, D, E would be way too small to count this as a WX, and this triangle is a wave Y. You can't have a flat in wave A of a triangle, A, B, C, D, E, right? So the fact that price took out this high doesn't work anymore for a triangle and then an A, B, C, D, E. So therefore the flat is actually the only scenario that remains in this particular case inside your wave Y, which means we move down, or, you know, it doesn't have to necessarily move down into the fibs. We can have a sideways bit of a range in a wave A, then get your B, then get your C. C would move into the fibs. Wave Y does not have to take out this low, doesn't need to doesn't need to take out a low of W as well, right? It can easily create a higher low, but as you can see, it would continue to range still, right? And still leads to a bit of a retracement, mainly in your wave C to the downside, right? So that is something that you like to see in this case, which is quite similar to what you see here. It's a little bit different. So again, WXY, but this time wave X, instead of being here, is here, which means wave X is now a triangle. And then a W, zigzag family structure, zigzag, by the way, not family structure, it has to be a simple zigzag in W. Then you have your wave X, which is a triangle, followed by your wave Y, which is a flat in this particular case, right, that I have on my chart. There is still, of course, a chance for wave Y to be a triangle, but because wave X is already a triangle, probabilities are incredibly low for Y to be a triangle, so it doesn't make sense to put it on the chart. So that's why I look for a flat here. So we have a wave A, wave B, wave C. Don't want wave B to move to 111.7K, would reduce the probabilities, and this is a common target for that wave B. But the main conclusion here is that you're looking for a move towards the downside in a wave C, in an A flat A, B, and eventually get a wave C to the downside, which can result to something like this, like the range we had between 73K and 49K. First move down, move up, move down, move up, get the final leg down, then you grind to the upside, couple of 1-2s, and then you explode, right? This will create a summer range pretty much, and then eventually you get that push towards the upside and move out of this particular range. This is a bars pattern taken from the range between 73 and 49 as mentioned, but that is what could happen with a C towards the downside. But it's just that the conclusion is the same. So even though I show different scenarios, which for some might be confusing, it's like, okay, so what's actually the preference here? It's the directional bias that you get comparing these scenarios with one another, but the general conclusion is the same. And that's the directional bias that can help in trading. And the directional bias, I will explain it more in the probabilities as we are getting closer to the end of this video. We have some news today as well, Tuesday, and then also on Thursday this week. Times are Central European time zone, so just make sure you trade safe, can increase the volatility. The support and resistance levels on the chart, slightly updated with some new levels as well locally here. So these are the support resistance areas, main resistance, 109, 111. Right, we have some local resistance as well. We already touched the support, so I removed it from my chart. We had support over here where price wicked into support. First reaction locally. Let me zoom in because I'm actually very zoomed out. So yesterday moved into support. We had the weekly naked point of control for the ones that remember the content of yesterday in the live stream. Nice initial reaction. Price moved back down. We're still officially, of course, hanging around that area of support, creating another little wick here with the candle. But because we touched it yesterday, I removed it from my chart. It's actually not really relevant to me anymore. And the levels that you see on my chart now here are the ones that are relevant to me. Then we have the volume profiles. So price moved to the upside. We kept an eye on the value area highs, acting as a resistance. Point of control is always an important level to keep in mind at 104.9K, right? And this is just two volume profiles taken from the start of the range and the all-time high extended all the way to the right. So then we get to the probabilities, and that is where the conclusion comes in once again. So when we look at the structure, look at the retracement, the probabilities are higher that a range or a retracement is not yet finished. Looking for wave 2, right? This is where the overlap happens between the different scenarios. If we want to see a wave 2, come on, man. We want to move into the fibs. It would be ridiculous to not see a 0 or at least a 0.236 touch, which already by itself is a very uncommon target for a wave 2. You generally be looking for a 382, an 05, golden pocket, a 786. Generally, you'd expect a retracement for a wave 2 to go to the sub-wave or the wave 4 or the wave 2, right? Of your wave 1. So the subwaves of wave 1. Those are areas of interest for a wave 2. We haven't even retraced to a 236, which for a wave 2 would be incredibly shallow. Now, never say never, but in this market, we're not here to be absolutes, right? Nothing is 100%. It's probabilities. And from a probabilities perspective for a wave 2, just doesn't make a lot of sense. It can happen, but if we would trade probabilities, then currently, this is not counted as a wave 2 yet. We just want to move into the fibs, right? So we would expect a bit of a retracement without it taking too long. We don't just want to go sideways, or even move towards the upside actually. We, for a wave 2, want to take a step back into the fibs and then want to move forward impulsively, right? That's something you like to see. So a retracement for this scenario would actually be best. Now in a flat, if we look for a wave B and a move to the downside, this is a continuation of the range, right? So the probabilities, as per written over here, are the same as actually with the bullish scenario. All right, so also here, preferably, we still look for a bit of a move to the downside to at least touch a 236 in either a wave B or an X, and then move to the upside to get the second leg, right, for wave B of a flat. But then after B, look for price to move towards the downside. Of course, I explained more earlier in the video about this scenario, so make sure to check it out. Price action may be relatively similar to a wave 2, but for a wave 2, you preferably retrace to a 382.05 golden pocket 786. And the wave B or a wave X, sure, it can be very shallow, 236, 382, right? Let's see if we even move into the fibs, because even if we don't, right, we got to be aware of this scenario. In a WXY, continuation of the range, right? Still looking for a retracement. Over here, by the way, your wave C is, of course, your retracement. You expect to move back inside the range. So wave 2 preferably retraces. In this scenario, preferably retrace and then move up, but then you still get a retracement in C after. This scenario, A, B, C, leads to a retracement. This one here leads to a retracement. So yeah, sure, we can push to the upside. We have very interesting resistance, which we haven't touched at 109 to 111K, which is definitely an area that I keep an eye on myself, as I write here as well. My main area of resistance is 109, 111. I'm very interested to see what price does there, if it can get there, right? But from an Elliott Wave point of view, probabilities explained. Bullish scenario, 0.236 isn't reached. WXY scenarios would expect more sideways price action, and in both cases, we would be looking for a flat, either like this, move into the 109K, 111K, reject, get a wave C to the downside, or here, right, we can still move a little bit higher and move down as long as you don't touch 111.7 in this particular case, right? Now, generally, the probabilities, right, generally, because we are looking at corrective structures here, so therefore, general probabilities are higher to still take out the all-time high. That is the high time frame directional bias. If we would zoom out, go to the higher time frame, higher, because this range has a higher probability of being corrective in WXYs or flats, right? Therefore, probability is higher to still take out the all-time high. So that is the higher time frame directional bias, which is important to, of course, keep in mind. I dislike to count this move to the downside as a 5-waver. Very difficult to count this as a nice impulse to the downside according to the rules and the guidelines of Elliott Waves, as per a lot of my content last week. If you are curious for the reason why, check out my 24-minute video or something that I made last week. Main area of resistance, main area of supports leveled towards the downside. And yeah, this is currently my analysis from an Elliott Wave point of view on Bitcoin. So hopefully you enjoyed this analysis, you found it helpful or valuable. On the left, you see a video on the simplest way to use and trade Elliott Waves without even counting. And on the right is the Elliott Wave educational playlist to help you understand more about Elliott Waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye-bye.